Hello everyone. Through this video today, I'm going to discuss an emerging topic of finance with you called exchange traded funds. We will look at exchange traded funds from the point of view of India as well as from the point of view of global markets. So, to begin with, exchange traded funds are a very recent innovation in financial markets. They were launched only about 3 decades ago in the early 90s, and they are an example of a basket security, which means that they hold multiple securities in their portfolio, and their value is derived from these securities only. And in the past few years, ETFs have gained immense popularity among the investors, among the institutional investors as well as retail investors, because they are very easy to trade and they are a low cost alternative to mutual funds, which are far more expensive. Now, ETFs combine the features of mutual funds as well as common stocks, because just like common stocks, they are tradable throughout the day in the market, and just like your mutual funds, they hold an entire portfolio, an entire stocks in their portfolio, and allow you to trade those stocks in one transaction. Now, the objective of this video will be to chronicle the origin and the development of the ETF industry, and to make you familiar with the different types of ETFs that are available in the market, and how the ETF markets have changed in India as well as at the domestic level in the last 13 to 14 years. So first of all, we will outline the history and the evolution of passive investing and the ETF industry with the special focus on India, and then we will look at the trends that are there in the ETF markets in the foreign as well as the domestic markets. So ETFs were launched only towards the end of the 20th century. They were launched in the early 90s, but the idea of index investing is not new. The first index fund was launched way back in 1975 by John C. Bogle, who was the founder of Vanguard. And at that time, people did not readily accept the idea of passive investing or passive funds. But today, the fund has become enormously successful, and it has, in 1999, it had assets worth more than 100 billion, up from just 11 million in 1975. And according to Gaston Yu, who is a major proponent of ETFs, the first instruments which bore some resemblance to modern day ETFs were the index participation shares, which were launched at the American Stock Exchange and the Philadelphia Stock Exchange in 1989. And the objective of these index participation shares was to artificially mimic the performance of the S&P 500 index. Now, there are three kinds of ETFs that are available to the investors. So, the first type, which is the most common, are called equity ETFs. Now, the purpose of equity ETFs is to track the returns of a basket of stocks. So, they hold stocks in their portfolio. And on the other hand, the purpose of fixed income ETFs is to track the returns of a basket of bonds. So they hold bonds in their portfolio. And finally, we come to commodity ETFs. Now, commodity ETFs track the returns of a particular commodity. That commodity may be gold, or that commodity may be silver. So, very recently, India launched its first silver ETF, and gold ETFs have been available to the investors in India for a very long time. And if we classify ETFs on the basis of the method of replication that they use, so ETFs can be of two types. The first one are the physical or the classical ETFs, which are the traditional form of ETFs. These funds actually hold the basket of stocks or the basket of assets that they're trying to track, and they are a simpler form of ETFs. Synthetic ETFs are they are a more recent form of ETFs, and they artificially mimic the returns of their underlying assets. They do so by holding some swap contracts and then executing them to mimic the returns of their underlying assets. In India, only physical or classical ETFs have been allowed, and synthetic ETFs are not allowed in India at the moment. So this graph shows the trends in the global ETF industry. So we can see that the trend has been it's an upward trend. It's a strong upward trend, and the global ETF assets have grown from 204 billion US dollars in 2003 to 7858 or 7.8 trillion US dollars at the end of 2020. So the ETFs have been growing at a compounded annual growth rate of CGA or CAGR of 22.38% between the period of 2003 to 2020. And if we look at the global markets, then the US market is by far the largest market, and it has assets surpassing 5 million US dollars by the end of 2020. Now, why has there been a shift to passive investing? So this shift to passive investing has basically been caused because the active fund managers, they have been unable to beat the markets consistently. They have been unable to consistently outperform the markets, and this is especially true for developed markets such as US and Europe. And because they have higher expenses ratios, so the investors feel that they would be better off by investing in ETFs, which offer them a comparable rate of return but at a lower expense ratio. So ETFs owe their popularity to the passive investing wave that has been going through the developed markets, and also to their rock bottom expense ratios and intraday liquidity, which is not available in case of mutual funds. Now, this table shows you the region-wise distribution of global ETF assets. As we can see, US is by far the largest markets of ETFs, followed by Europe, Canada, Asia Pacific, and then at the end we have Latin America. And if we compare the categories of the ETFs, then equity ETFs is the largest category. And then we have fixed income ETFs, and commodity and other kinds of ETFs is the smallest category of ETFs that is present. Now we will look at the evolution and trends that are there in the Indian ETF industry. So the concept of ETFs in India is not actually new. The first ETF in India was the Nifty Bees, which tracks the returns of the Nifty 50 index, and it was launched way back by the Benchmark Asset Management Company in 2001. So Benchmark Asset Management Company was actually a pioneer in launching ETFs in India. After launching the first ETF in India, that is Nifty Bees in 2001, they went on to launch the first money market ETF, which was the Liquidity Bees in 2003, and then they launched the first commodity ETF of India, that was the Gold ETF in 2007. And at the end of 2020, the assets under management of the Indian ETF industry stood at 37.2 billion US dollars. So, if we look at the proportion of ETFs as a proportion of the mutual fund industry as a whole, we will see that the average percentage has remained quite low. On an average, the percentage has been around 2.59%, but the ETFs have been rising steadily since 2015, and investors have now started accepting the ideas of ETFs, and they have started pouring money into ETFs. And if we compare the it is across categories, then index ETFs occupy the majority proportion of the total ETF assets during recent times. So ETF industry has grown fairly quickly in the last few years. In the 2014 to 2020 period, it has grown at a CAGR of 68.29%, and the mutual fund industry grew at only 16.71% during the same time period. So during the last 6 or 7 years, the growth rate of ETF has surpassed that of mutual funds by a big margin. So this is the share of ETFs in the mutual fund industry. We have two category of ETFs that we have shown here. First one is the gold ETFs, and the second one are the index ETFs. So from this graph, we can see that earlier the proportion of gold ETFs was higher as compared to the proportion of index ETFs. But post 2014 and 2015, the proportion of index ETFs has risen rapidly, while that of gold ETFs has fallen. So index ETFs are rising and gold ETFs are falling in recent times. So why is this happening? Because after 2014-15, the markets had recovered from the global financial crisis of 2009 and that were there, and people were starting to accept the idea of index ETFs. And so the investment in gold ETFs declined because the stock markets were rising at this time because the recovery had set in, and at the same time index ETFs saw a boom. This graph shows you the assets under management of domestic ETFs and index ETFs over time. So this graph is similar to the graphs that we saw previously. The AUM, or the assets under management of gold ETFs, has stagnated and it has not risen very rapidly, while index ETFs have shown an exponential growth. They have been rising at a very high rate, especially after 2015. So, if we compare the growth of index ETFs and gold ETFs, we saw that the proportion of index ETFs fell during the 2008 to 2011 period, but the growth of ETFs, especially index ETFs, has risen since 2015, while the growth in gold ETFs has since declined. So this trend, as we discussed earlier, is likely the result of global financial crisis, because during this crisis, the value of the equities around the world was falling, and as a consequence, investors were flocking towards the gold market, which is a safe haven for their investments. But in since 2014-15, the market has recovered quickly, and so the cumulative annual growth rate for index ETFs has been about 68.29%, and the mutual fund industry, as we saw earlier, grew at a much slower rate during the same time period. So this graph shows you the growth rate of mutual funds and ETFs over time. So we can see that the mutual funds have been growing. Their growth rate has somewhat stabilized as compared to ETFs. ETFs have been growing at a much faster rate as compared to mutual funds. This table shows you the number of schemes in gold and index ETFs. The number of schemes in gold ETFs has not increased much. It was just there were just 4 schemes in 2007, and in 2020 there were only 11 schemes. On the other hand, the number of schemes in index ETFs has grown quite rapidly. In 2007, you had just 8 schemes, but if you wanted to invest in an index ETF in 2020, you have 89 schemes that you can invest in. So there has been a major rise in terms of the number of schemes that are available to uh, investors who want to invest in index ETFs. Now, this graph shows you the growth rate comparison of Indian and global ETFs. So we can see that the graph of the Indian ETFs, it's a lot more volatile as compared to the global ETFs. So the year on year growth rate of Indian ETFs is far more volatile as compared to the year on year growth in global ETFs. And the reason for this is because the base is smaller. Indian ETFs markets are smaller, so whenever there is a change, the growth rates are generally higher as compared to global ETFs. So, why are ETFs rising so much in India? So, first of all, it is likely a result of the passive investing revolution that has taken over the world. So, that that increase has been felt in the Indian ETF markets as well. So, the exponential growth in global markets is one of the reasons why ETFs have been rising in India so much. Secondly, the central government has chosen the ETF route to divest its holdings in the public sector. So the first disinvestment was in the form of the CPSE ETF, and then there came the Bharat 22 ETFs, and both of these ETFs have become very popular among the investors, and they have been oversubscribed multiple times in all their tranches. Thirdly, the Employees Provident Fund Organization has been steadily increasing its investment in ETFs. They have chosen ETFs as their main avenue for investing in the equity markets, and in 2015-16, 5% of their deposits were invested in ETFs, and in 2017-18, this had gone to 15%, and it is still rising now. So to conclude, we can say that the ETF market in India is still quite small if we compare it to its global counterparts. But the percentage of the Indian ETF industry as a percentage of the global ETF industry has been rising in recent times. So the CAGR for the global ETFs during the 14-year period was about 22.49%, while the same figure for the Indian ETF assets was far higher at 52.82%. So Indian ETF assets have been growing at a faster rate as compared to their global counterparts. And finally, the increase in the number of ETF schemes. And there is greater awareness among the individual investors about the benefits of ETFs, the government's disinvestment program, and also the investment in ETFs by EPFO. All of these factors are contributing towards building a more vibrant ETF market in India in the near future. So, thank you.